So I am in option chain. So I have opened Nifty option chain. You can also access the analytic from the link in the description box below. And option chain out here in Quantsapp is absolutely free and it updates in real time. So do check out the link and access option chain. So now what I want to show you all is, now just check this thing out. So market right now is at 17,750. 150 point far away put option IV implied volatility is trading at 11.1, whereas 150 points far away call option implied volatility is 9. So generally, if you just see, what you can observe is put option IVs, put option implied volatilities are relatively higher as compared to call option IVs. Okay, if you just focus, just spend 1 or 2 seconds, you will easily figure out that IVs on the put side are much more higher compared to the IVs on the call side. Now why is this happening? It's happening because the market is trying to account for the risk of destructive moves happening in the market. What I mean by this, so there is a general phenomena in the market that whenever market falls, it will fall down more and it will fall down a bit faster. Whenever market corrects, it will correct more and it will correct faster. So one of the most textbook examples for this is COVID scenario. So now if I just show you, so let's just draw it. So let's say data range. I just want to know date range. So now if I just roughly draw it, market took how much? 20 days. But if you talk about calendar days, it took 29 calendar days or 20 trading days roughly to correct. How much? From 12,000 to market came down to 7,500 roughly. So a 35 percentage fall is what we saw in the market in 20 days. But now for the same market to bounce and go back to its normal level, okay, from when the market is going up. Now, if you just see, it took long time. So when did the market come up? So market came up at the normal range at this day, which is after 139 days, right? After 139 trading days and after 204 calendar days, market recovered from the bottom and came back to its normal or to the level where the market, from where the market had corrected. So now what does this conclude? So this concludes that whenever the put option traders are trading puts, so they are trying to account for the more risk, the additional risk of instrument correcting a bit faster, and whenever it goes up, it goes up slowly. That is the reason the call option IVs, they are relatively lesser as compared to put option IVs. In simple words, in one line, He Traders Quantsapp has simplified option trading analytics for you. Click the link in the description box below, complete your sign up process and access the most advanced option analytical tools in the entire industry. Thank you. Put traders are charging more implied volatility in order to account for the risk of instrument going down faster and going down in huge quantum. Okay, जब गिरेगा तब ज्यादा गिरेगा, जब ऊपर जाएगा तब कम ऊपर जाएगा, is the risk what the option traders are trying to account for. And typically the market has phenomena that whenever there are destructive moves in the market, they will be fast and very big. The constructive moves in the market, it will take time and it will be slowly and steady up moves. But now the question is, we being option traders, how can we use this information? Okay, so one of the simplest ways of using this information is that whenever you are bearish on the instrument, okay, that means if you are expecting that the instrument might collapse. So now how do you use this information in trading? So one of the simplest ways of using this simple knowledge of what we have right now is by trading options. So now how do we use this information in trading? So one of the most simplest ways is that whenever we are expecting some kind of bearishness to play out in the market, at that time, we will consider buying a naked put option over any other strategy. Specifically, if I am trading intraday options, my to-go strategy would be buying a put option, ATM or 1 or 2 strikes around ATM, most preferably ATM. But still, if you are very far off from the expiry, you can prefer to go 1 strike away from the ATM. That is also okay. Okay. So now why we are doing this? So if I just buy a put option and show you. Okay, so now this is how the strategy looks like. So more market corrects from here, more pay, more profit this strategy is going to give us. Now the max loss is 2,700. So now just focus on my cursor right now. So what it is trying to tell me? It is trying to tell me that if the market remains at 17,760, I'll make a profit of 192 today end of the day के हिसाब से. So I'm asking the app, what will be the impact if the IV goes up by 20%? So now if you see at the same level, I am making a profit of 782 rupees. If the IV goes up even further, let's say by 40%, just a hypothetical figure. But now if you see, even if market remains exactly where it is right now, still you will end up making money. On one lot, you're still making a profit of 1500 rupees, which is very significant. Okay, so basically first thing is that whenever the market, you're thinking that, okay, any of your technical indicator gives you an indication that the market might correct from here. The simplest strategy is long put instead of going for complex spreads. Now, what else you can do is, now let's say for an instance, you are trading this strategy, but you might have to hold this strategy for some time. So in such type of scenarios, what you can do is you can convert this strategy into a spread. Now let's say I want to hold this strategy till expiry. Now what is the problem? The problem is nothing but the theta which is decaying. So if you just see at the same level, if market remains exactly where it is, it will give me a loss of 2,700 till expiry. Even if market falls till 17,700, still it doesn't help me. Still I am making a loss of 164 rupees till expiry. So what I'll do, I click on add leg and select put option first of all, and then select the strike price. So what I'll do, I'll sell a put option, I'll sell an additional put option, or I would say I'll hedge this position by selling a put option, and this is how it will look. Now, if you see, the loss which I was making was 2,700 in a long put. I have converted that loss into just 1,800 rupees. Now, still I am making significant return in this strategy. Even if market goes to 17,690 approximately, still 1,200 rupees is in my pocket. So, simple strategy. And why we are trying to create this? First, you will never know that how much time the strategy might take. So you need to evolve your strategy. So first you can start off with long put, and then you can convert that strategy into a bear put spread, a bearish strategy using put options. Now, if you just check out the Greeks, so you will get to know the theta impact, how much the theta is getting outflowed or how much net theta you are paying to the market. So it's just 136 rupees, which is okay. Now, another type of strategy is like, now let's say if you are bullish on the market, then what you'll do? So let me just reset everything. So now you can create a bullish strategy using put option as well. So again, go to custom strategy. First, select put option always. And then whenever you are creating a put option, you need to sell a put option, a lower strike or a higher strike put option. Basically in the money or at the money put option is what you will try to sell. Okay, and this is how the payoff strategy will look like. But it won't make sense to short a naked put option. So for that, what we are doing is we are going ahead and buying a put option of out of the money. And this will be converted into a bull put spread. And this is more or less, generally, whenever you are doing this closer to expiry, this would be a theta positive strategy. Only thing is, if you select over here, the strike selection matters a lot. So this strategy might not give you, if you manually build it and if you don't select proper strike prices, it may not give you optimal reward to risks, but we have a fix for that. But you can use this strategy in order to get rid of theta as well as you can remain in the view for a longer time. Now if you see, if I just give inputs that if the IV goes up by 20%, see at the same level you are not making any loss. If the market goes up from here, you will end up making profit. So that way, and let's say if the IV collapses, so now see what's happening. If IV corrects by 27% from here, you will make a profit of 330 rupees in this strategy. So why this strategy when the market is bullish? Because this strategy will give you money of direction plus the crash in implied volatility, the crush in implied volatility. So see, I am assuming that you know that whenever market goes up, the IVs goes down. So if the IVs go down, then still you are in the view, you are getting benefit of IV, you are using IV as the profit booster, plus you are getting directional benefit as well. Now, to conclude the video, if you want to build yourself a best bull, bear put or a bear calls, any strategy, okay, any strategy, you can go to find specific and you can define the direction. Let's say you want to build best bull put spread. Give input to the optimizer and optimizer will recommend you top 5 actionable option trading strategies which are optimized looking at the various competitions and permutations. So do check out architect tool, optimizer tool and option chain tool to build yourself best option trading strategies. Thank you.